Everyone talks about 59 and a half. That's when you can finally withdraw from your retirement accounts without the IRS taking a 10% penalty. Then there's 62, when Social Security becomes available. And, of course, 65 when Medicare begins. But there's one age almost nobody talks about: 61. And ignoring what happens at that age could quietly cost you $300,000, even $400,000 over your retirement. Not because you made bad investments, not because the market crashed, but because of a timing mistake that most retirees never see coming. In fact, the difference between making one financial decision at 61 instead of 63 can mean the difference between paying thousands more in taxes and Medicare premiums every single year. So today, we're going to break down why age 61 might be the most important year of your entire retirement plan, and how missing this tiny window could cost you a fortune without you even realizing it. Part 1. Why age 61 matters. Everyone talks about 59 and a half. That's the famous milestone in retirement planning. The age when you can finally open your 401k or IRA without the IRS hitting you with that painful 10% early withdrawal penalty. Financial podcasts talk about it constantly. HR departments send reminder emails about it. Even your friend who suddenly became a finance expert after one lucky investment somehow finds a way to mention it. Then there's 62. That's when Social Security becomes available. Not necessarily the best time to claim benefits, but it's the first moment you can. And because of that, it gets a lot of attention. And of course, everyone knows 65. That's when Medicare eligibility begins. For many people, it feels like the official start of retirement. But right in the middle of those famous ages, there's one that almost nobody talks about: 61. No financial podcast discussing it. No letters from the government warning you about it. No milestone reminders from your bank. Just silence. And that silence is expensive, because ignoring what happens around age 61 could quietly cost a typical couple $300,000 to $430,000 over the course of retirement. Not because they made bad investments, not because the market crashed, and not because they didn't save enough, but because of something much more boring: timing. The truth is, retirement planning isn't just about how much money you save. It's about when you make certain decisions, when you convert money, when you realize income, when you start benefits, and when certain government rules start applying to you. And here's the part most people never realize. Your financial life works like a series of doors. When you're younger, almost every door is open. You can change strategies, you can move money between accounts, you can adjust how your income is taxed, but as you move through your 60s, those doors begin to close. And once they close, they lock permanently. You don't get a second chance to walk through them. That's why age 61 is so important. Because it sits right at the edge of a narrow window. The final moment when you can still make certain financial moves without triggering a chain reaction of taxes, Medicare penalties, or benefit reductions. After that window closes, every financial decision becomes more complicated. Every dollar of income can start affecting something else: taxes, Medicare premiums, Social Security taxation, future required withdrawals. The system becomes a maze of rules and thresholds. But at 61, the maze hasn't fully activated yet. And that gives you a powerful advantage if you know how to use it. In this video, we're going to break down exactly why age 61 is one of the most important years of your entire retirement, how the system changes once you reach 63 and 65, and how a few strategic decisions before that birthday could potentially save you hundreds of thousands of dollars. Because the biggest retirement mistake isn't running out of money, it's losing money to rules you didn't know existed. Part 2. The Medicare Trap. That starts at 63. To understand why 61 is so powerful, you need to understand what happens just a couple of years later. Because at age 63, something important quietly begins. And most people have absolutely no idea it exists. It's called the Medicare IRMAA lookback. IRMAA stands for Income-Related Monthly Adjustment Amount. In simple terms, it's a rule that says if your income is higher, you pay higher Medicare premiums. That sounds reasonable on the surface. But the way the system actually works is where the trap appears. Medicare doesn't look at your income today to determine your premiums. Instead, it looks at your income from 2 years ago. So when you turn 65 and enroll in Medicare, they look at your tax return from when you were 63. And that creates a strange delay between your financial decisions and their consequences. Let's say you retire and decide to do a large Roth conversion at age 63. Maybe you convert $100,000 from your traditional IRA to a Roth IRA. On paper, that seems like a smart move. You pay taxes now, move money into a tax-free account, and reduce future required minimum distributions. But that conversion shows up as $100,000 of income on your tax return. 2 years later, when Medicare calculates your premiums, they see that spike in income, and suddenly you're pushed into a higher IRMAA tier. That means your Medicare Part B premiums could jump hundreds of dollars per month. Sometimes even more, and here's the frustrating part. That Roth conversion might have been a one-time event, but the system doesn't know that. It simply sees a high-income year and assumes that's your normal income level. So you end up paying higher premiums because of a decision you made years earlier. Now imagine those extra premiums lasting across an entire retirement. Over 20 or 25 years, that can easily add up to tens of thousands of dollars. Sometimes over $100,000 in extra costs. All because of the timing of one decision. And this is exactly where age 61 becomes so important. Because if you make that same Roth conversion at 61 instead of 63, it never shows up in the Medicare look-back window. The move is identical. The taxes are identical. But the downstream Medicare penalties never happen. That's the difference timing can make. 2 years, same strategy, completely different outcome. Part 3. The $100,000 timing mistake. Let me show you how this plays out in real life. I once spoke with a retiree, let's call him Richard. Richard did everything right. He worked for nearly 35 years, consistently contributed to his 401k, avoided unnecessary debt, and invested carefully. By the time he turned 60, he had built a retirement portfolio of about $1.2 million. Most of it sat in traditional retirement accounts. Exactly what most financial advice tells people to do. Save, defer taxes, let the money grow. When Richard retired at 60, he knew about Roth conversions. He had read articles explaining that converting some of his traditional retirement money into a Roth IRA could reduce taxes later in life, especially once required minimum distributions start at age 73. So his plan seemed simple. Convert some money each year, spread out the taxes, gradually move money into a tax-free account. At 61, he converted $20,000, no big deal. At 62, he converted another $20,000. Still fine. Then at 63, he decided to get more aggressive. He converted $150,000 in 1 year. From a tax perspective, the move actually made sense. His income was relatively low. He had cash available to pay the taxes, and he was reducing the size of his future RMDs. Everything looked good, until 2 years later. When Richard turned 65, he enrolled in Medicare. A few weeks later, a letter arrived. His Medicare Part B premium wasn't the standard amount. Instead of paying the normal monthly premium, he was paying nearly 3 times more, because his income at age 63 had pushed him into a higher IRMAA bracket. That single Roth conversion had triggered a higher Medicare premium tier, and the result was an extra $4,000 per year in premiums. Now, $4,000 per year might not sound devastating, but stretch that across a 25-year retirement. That's $100,000 in extra costs. Money that could have stayed invested, money that could have gone to his children or grandchildren, money lost to a timing mistake. And here's the painful part. If Richard had done that same $150,000 conversion at age 61 instead of 63, none of this would have happened. Same strategy, same tax bill, same financial outcome, but without triggering the Medicare look-back. One small shift in timing could have saved him 6 figures, and that's exactly why understanding the timing window around age 61 matters so much. Because once you pass certain ages, the system starts watching. And when the system is watching, every financial decision suddenly becomes more expensive. Part 4. the 4 strategies you can use before the door closes. So, what exactly can you do at age 61 that becomes harder just a couple of years later? There are 4 powerful strategies that become extremely valuable during this short window. And when used together, they can preserve hundreds of thousands of dollars over retirement. Strategy 1. Large Roth conversions. The first strategy is Roth conversions. You already know the basic idea. Move money from a traditional IRA or 401k into a Roth IRA, pay taxes today, and allow that money to grow tax-free forever. But timing is everything. At 61, you can convert large amounts without worrying about Medicare's IRMA lookback. Medicare simply isn't watching yet. For example, imagine converting $200,000 into a Roth IRA. You'll still owe taxes on the conversion. But because the income happened before the IRMAA lookback window, it won't increase your Medicare premiums later. The same move at 63 could quietly increase your healthcare costs for years. Strategy 2. Capital gains. Harvesting. The second strategy is something most people have never heard of. It's called capital gains harvesting. Under current tax rules, if your taxable income is low enough, you can pay 0% federal tax on long-term capital gains. For married couples, that threshold is roughly around $90,000 to $100,000 depending on the year. That means you could sell appreciated investments, realize tens of thousands of dollars in gains, and pay no federal tax at all. Then you simply buy the investment back. Your cost basis resets higher, and you've permanently erased a future tax bill. At 61, this can be done without triggering Medicare penalties later. Once you're inside the IRMAA window, those same gains may have hidden costs. Strategy 3. ACA health insurance optimization. This strategy is especially powerful for people who retire early. If you retire before 65, you'll likely get health insurance through the Affordable Care Act marketplace. And those plans often come with large subsidies depending on your income. Some couples receive $10,000 to $15,000 per year in premium subsidies. But those subsidies disappear if your income climbs too high. At 61, you still have several years before Medicare begins, so you can carefully structure your income to qualify for subsidies while still optimizing taxes. Once you hit the IRMAA lookback window, the planning becomes much more complicated. Strategy 4. Strategic income planning. The final strategy is income coordination across all your accounts. In retirement, most people have money in 3 different tax buckets: tax-deferred accounts, traditional IRA/401k, tax-free accounts, Roth IRA, taxable brokerage accounts. The goal is not to minimize taxes in one single year. The goal is to minimize taxes across your entire retirement. At 61, you have the most flexibility. You can decide where income comes from. You can shift money between buckets. You can fill lower tax brackets intentionally. But after 63, every income decision can trigger new consequences. Higher Medicare premiums, higher Social Security taxation, higher overall tax brackets. The freedom begins to disappear. That's why age 61 is so important. It's the last moment when you can still move money freely without the system adding extra costs to your decisions. Miss that window, and the same strategies suddenly become much more expensive. Part 5. The $350,000 difference. Let's make this real with a simple comparison. Imagine 2 couples. They're almost identical. Both are 60 years old. Both have saved about $1.8 million in traditional retirement accounts. Both have $200,000 in Roth accounts and about $300,000 in a taxable brokerage account. They plan to retire at 61, and they need about $75,000 per year to live comfortably. Everything about them is the same, except one small detail: timing. Couple A uses the age 61 window. Couple A understands the timing window, so as soon as they retire at 61, they begin optimizing. During ages 61 and 62, they aggressively convert money from their traditional IRA into a Roth IRA. They convert around $200,000 total during those 2 years. They also harvest capital gains while their income is low, taking advantage of the 0% capital gains tax bracket. Because they're still outside the Medicare IRMAA lookback, none of these moves increase their future Medicare premiums. When they reach 63, they slow down. They're now inside the IRMAA window, so they carefully limit how much income they generate each year. By age 70, they've converted around $400,000 to Roth. That means smaller future required minimum distributions, lower tax brackets in their 70s, more control over their income. Couple B waits too long. Couple B does something most people do. They retire at 61, but they wait. They spend the first couple of years simply living off their brokerage account. They don't run Roth conversions. They don't harvest gains. They assume they have plenty of time. At 63, they finally start optimizing. They convert $100,000 per year for several years. But now they're inside the Medicare IRMA lookback window. Each conversion pushes their income higher, and those higher income numbers show up 2 years later when Medicare calculates their premiums. So starting at 65, they begin paying higher Medicare premiums. Over the next decade, those extra premiums add up to roughly $15,000 or more. But that's not even the biggest problem. Because they converted less money overall, their traditional retirement accounts remain much larger. When required minimum distributions begin at age 73, they're forced to withdraw more income every year, which means higher taxes, more Social Security benefits taxed, more Medicare premium surcharges. The result, after running the numbers over a 30-year retirement, Couple A ends up with about $350,000 more after-tax wealth than Couple B. Same investments, same starting savings, same lifespan. The only difference was that one couple used the age 61 window, and the other couple missed it. Part 6. The retirement window. Most people miss. Here's the strange thing about retirement planning. Most people spend 40 years focusing on saving money. They worry about investment returns, they worry about market crashes, they worry about whether they saved enough. But once they reach retirement, the biggest risk often isn't running out of money. It's losing money to inefficiency. Taxes that didn't need to be paid, Medicare premiums that could have been avoided, required withdrawals that force income into higher tax brackets, all because of decisions made at the wrong time. And that's why age 61 matters so much. It's not just another birthday. It's the final moment when several powerful financial doors are still open at the same time. You can still run large Roth conversions, harvest capital gains at 0% tax, structure income to maximize health insurance subsidies, reduce future required minimum distributions, and most importantly, you can do all of that before the Medicare system starts watching your income. After 63, every financial move begins to interact with new rules, hidden thresholds, look-back windows, premium surcharges. The maze gets more complicated, but at 61, you're still standing outside the maze. You still have room to move. You still have the ability to design your retirement income before the system begins making decisions for you. And the difference between using that window or missing it can easily be hundreds of thousands of dollars over a lifetime. So if you're approaching your 60s, or already there, this is the moment to start thinking differently. Not just about how much money you have, but about when you use it. Because in retirement, the biggest financial advantage isn't always saving more. Sometimes it's simply understanding the timing of the doors before they close.